Hello, Kurt Jackson with KJ Financial here. In our second module for our Retirement Accelerator Blueprint, we're talking about the 10 biggest risks in retirement. We are on risk number 6, inflation risk. So inflation risk is one that, as we put this together in early 2023, has certainly reminded us how ugly inflation can be. So here's the thing, even low amounts of inflation can still wreak havoc on your retirement. So a 3% inflation rate will cut your spending power in half in just 24 years. Or if you're already in retirement, that means your income would have to double in 24 years just to keep up with inflation. It's a big ouch. Remember our income example with the better of the two good sequence of return examples with income? So over 25 years, the income grew from $40,000 to $81,312 at our assumed 3% inflation rate. So currently inflation is about 6%. If we use the rule of 72, it would take just 12 years to double what you need to keep up with inflation. So the rule of 72 says it takes 72 divided by the inflation rate, and that will give you a close idea of how many years it'll take to double what your income needs to be or cut your spending power by half. So if any length of time in retirement has these higher rates of inflation, it's going to take a heck of a lot more money to help you keep up with inflation. So isn't inflation another reason to protect what you have and still grow it? So is safe and productive growth found inside the Retirement Accelerator Blueprint sounding better and better yet? So inflation is also called a stealth tax. It sneaks up on you. Also, inflation doesn't discriminate. It hits poor folks and it hits rich folks too. Although a solid argument can be made that it hits the poor more because they don't have much, if any, room to cut back on what they buy and still be able to live and survive. So inflation could be the absolute biggest risk for your retirement. And even if it isn't, it's still a very formidable risk that you must be prepared for. And just to give you an idea of the power of inflation, remember our income example in the good sequence of returns where the traditional planning's market example made it from age 65 through age 89 and still had $501,777 left. And our alternative option made it through age 89 and had $2,129,525 remaining. Well, if we boost the inflation rate in retirement to 7% in this scenario, then the market example runs out of money at age 82, and after age 89, the alternative has just $83,513 remaining. So doesn't that mean experiencing a 7% inflation would have eaten up almost all the $2 million plus surplus you had in our alternative plan that we had with a 3% inflation rate? So see how powerful inflation can be? So in order to battle inflation, wouldn't we need to make sure all our money and retirement strategies are working at peak efficiency? So wouldn't that mean avoiding losses, being linked to the market or other indices, locking in gains on an annual or biennial basis, and protecting our money from loss going forward? Plus, some other aspects of the Retirement Accelerator Blueprint are designed to help protect or overcome the myths and lies that we've been told and taught in traditional planning. And plus, don't forget our 10 biggest retirement risks. So you're ready for the 7th risk, healthcare costs. So go ahead and click on the video below and let's check out risk number 7.